We're going to talk about a topic that becomes more and more important as we approach or enter retirement: liquidity. Specifically, how you can unlock the equity you've built in your home to fund your future and live more comfortably. My name is Ruth. Don't worry about the last name. Just think of me as Ruth, the reverse mortgage expert at Nexa Mortgage. Okay, people are always asking me how I pronounce my last name. My answer is I don't, but here's a hint: Joe Hanningsmeyer. Just a little about me. I am a mortgage advisor with Nexa Mortgage, and my passion and specialty is helping people navigate their options for retirement and liquidity. I've even written a fictional book to help understand the situations some people might face. My first one was called Winning the Lottery. The second is Grandma's on the Roof. My goal is always to provide clear, honest advice tailored to your specific situation. Now, let's start with the big question. Do you want or need to access the money that's tied up in your home? For many retired homeowners or those about to retire, their home is their largest asset, but it's not liquid. You can't use it to pay for healthcare, travel, or unexpected expenses. The good news is you have powerful options to change that. Today, we'll focus on three main tools: the home equity line of credit, or HELOC, the reverse mortgage, and a more specialized product called the all-in-one loan. Let's start with the one most people have heard of: the HELOC. On the pro side, it's generally a quick and easy process. It's an excellent tool if you need money for a short period of time, say for a home renovation project that you'll complete in 6 months or less. It gives you a line of credit that's available when you need it. However, there are significant cons, especially for retirees. First, interest rates are usually variable, meaning your payment could go up every single month, which can be stressful on a fixed income. You are also required to make monthly payments on whatever you borrow. And here's the biggest risk: the bank can take the line of credit away. If your credit score drops, if property values in your area decline, or if your income changes, the lender can freeze or even close your account, often when you need it most. Next, let's talk about a loan designed specifically for homeowners in retirement: the reverse mortgage, officially known as a home equity conversion mortgage, or HECM. The single biggest pro is that you are not required to make a monthly mortgage payment. You still have to pay your property taxes and homeowners insurance, but the loan payment itself is eliminated, freeing up significant cash flow. It's also a non-recourse loan. This is a critical feature. It means you or your heirs will never owe more than the home's value when you permanently leave the home. This protects your other assets. Finally, it provides incredible peace of mind knowing you have access to funds without outliving your money. This is a key point, and it's where my disclaimer, "talk to me," comes in, because everyone's situation is unique. Now for the cons. It can seem expensive up front because, in addition to standard closing costs, there is a 2% FHA mortgage insurance fee. This insurance is what protects you and makes it a non-recourse loan. You're also limited on the amount of equity you can access, and to qualify, you generally need to be over 62 and have more than 50% equity in your home. Finally, I want to introduce a lesser known but powerful tool: the all-in-one loan. This is not your grandfather's mortgage. It's a sophisticated financial tool that acts like a combination of a HELOC and a reverse, but it's really more like a business line of credit secured by your home. I personally have this mortgage because I was too young for a reverse. The pros are substantial for the right person. With this loan, your deposits, like your income, go directly toward the principal first, which can save you a massive amount of interest. The rates are often much better than a HELOC, especially if you're financing a second home or an investment property. In essence, you become your own bank with tremendous flexibility and even potential tax advantages. But this loan is not for everyone. The cons are straightforward. You need excellent credit to qualify. The loan approval process is far more invasive and detailed than a standard mortgage. And because of these strict requirements, many people simply may not qualify. Another disadvantage is that many people just don't get it. Mortgages in the United States have been generally the same since the Great Depression. If someone is an entrepreneur or mentions that they were one of the first to make biweekly payments, I'm confident that this is something that they need to investigate further. Now, let's see how these products work in the real world. This is Mary's story. She was in a tough spot. She owed a large assessment on her condo. Her husband was in hospice, and she was on a limited fixed income. She was under immense stress. For her, the HELOC was the perfect solution. She needed money fast and just didn't have the emotional energy to go through a complex process. She borrowed enough to pay the assessment, cover immediate medical bills, and even prepay 6 months of the HELOC payments to give herself breathing room. Critically, her husband had a life insurance policy that she knew would cover the loan balance, making the HELOC a safe, short-term bridge during a difficult time. Next, meet Joe. Joe was in a completely different position. He owned his $1.5 million home outright and had another $700,000 in retirement accounts. He didn't need money now, but he was a smart planner and wanted a safety net. He chose the FHA HECM, or reverse mortgage, as a line of credit. This was brilliant for him. The unused portion of his credit line will actually grow over time, independent of the home's value, giving him access to more money later. The line can't be taken away by the bank and has no end date, so he knew it would be there for him until the day he died. Most importantly, he only incurs interest if he actually uses the money, allowing his other retirement accounts to continue growing untouched. A lesser known fact is if Joe's children want the home and he has borrowed more than it is worth, they can buy the home at 95% of the appraised value. And finally, there's Kevin. His home had doubled in value, but he still had a large mortgage at a fantastic 2.5% rate. He wanted to move, had a high income, and his big goal was to retire early. Kevin was too young for a reverse mortgage, so he chose the all-in-one loan for his new home. The variable rate was much cheaper than a fixed rate would have been at the time. His plan was to use his high income to rapidly pay down the principal. He knew he could pay off the entire loan when he sold his first home, and the line of credit feature gave him the financial cushion and flexibility he wanted to confidently step into an early retirement. He was a perfect candidate for this sophisticated tool. As you can see from these stories, there is no single best answer. The right choice depends completely on your personal goals, your financial picture, and your timeline. Are you looking for a short-term bridge like Mary, long-term security like Joe, or maximum financial efficiency like Kevin? The most important step is to understand all your options. And the best way to do that is to have a conversation with an advisor who can look at your whole picture. If any of these loans are of interest to you, or even if you want a traditional mortgage or commercial product, please contact me, Ruth, the reverse mortgage expert at Nexa Mortgage at 828-888-LOAN for a free consultation.